The perfect entry point. Every trader chases it, every amateur thinks he's found it, and every professional knows it's an illusion until you learn how to see it. Let me tell you something. The perfect entry point isn't about guessing the bottom or buying cheap. It's about understanding the rhythm of the market and stepping in only when the odds are stacked heavily in your favor. You see, the market has moods like a person. It breathes, it hesitates, it surges, it tests your patience, and if you don't learn how to read it, it will rob you blind with a smile on its face. When I was young, standing in the bucket shops, I thought every dip was a buying opportunity. Every little rally looked like the start of something big. But the longer I stayed in the game, the more I realized that the market doesn't reward excitement, it rewards patience and precision. The perfect entry point, for me, came down to one simple truth. You don't trade because you want action, you trade because the market times forces times you to act. When all 5 of my conditions align, I act quickly and decisively. When they don't, I do absolutely nothing. Let's talk about what I mean by those 5 steps, the test I use before every single buy. But before we get into that, I want you to understand something crucial. There's no magic formula that works forever. What I'm sharing with you are principles built on observation, discipline, and human psychology. The market changes, but human behavior does not. The fear, greed, hope, and ignorance that drive prices today are the same emotions that drove them a century ago. Learn to read those, and you'll see through the ticker tape like it's written in plain English. The first step of my test is what I call the general market condition. You must never buy against the major trend. I've seen more fortunes lost because of ignorance of this one rule than any other. When the general market is in a bear phase, every rally is suspect. When it's in a bull phase, every dip is an opportunity, but not every dip is safe. Before I buy, I ask myself, is the tide rising or falling? Are most stocks making higher highs, or are they struggling? You can't swim against the tide and expect to get far. I learned that lesson after losing a fortune trying to pick bottoms in 1907. The market didn't care about my logic, it cared about momentum. So I stopped guessing and started aligning myself with the prevailing trend. The first step is to ensure the general market is in harmony with your intended direction. If it's not, close your notebook and go fishing. The second step is the sector or group movement. Money moves in groups. When the steel stocks go up, they often go up together. When the rails fall, they usually fall in unison. The public loves to believe their stock is different, but I've never seen a stock defy the gravity of its group for long. So before I buy, I study the behavior of the entire sector. Is the group leading or lagging? Is there strength in the majority of related issues? A single stock might fake a move, but a whole sector rarely does. I want to see the group showing power before I put a dime on the table. If the group is weak, I step back. Remember, your stock is like a soldier. No matter how brave he is, he can't win if his regiment is retreating. Now, the third step is where most amateurs fall apart, the individual stock behavior. Here I'm not interested in opinions or rumors, I'm interested in action. How does the stock behave when it's tested? When it falls on bad news, does it recover quickly? When the general market dips, does this stock hold steady or break down entirely? These are clues. They tell me whether the big operators are accumulating or distributing. A strong stock doesn't react like the weak ones. It resists decline and leads the rallies. I've made my biggest money in stocks that refused to go down when everything else did. That's your clue. The professionals are quietly building positions. They don't talk about it. They just buy it, and the tape tells you so. When I see that behavior, I know I'm close to a proper entry. But that's not enough. The fourth step is the price confirmation. You never buy because you think it's cheap. Cheap can always get cheaper. You buy because the stock times proves times it's strong. My rule was simple. I never bought on the way down, only on the way up. That may sound strange, but let me explain. When a stock breaks through a previous resistance level on heavy volume, it's telling you the path of least resistance is upward. The operators have finished their accumulation. The public doesn't see it yet, but the insiders are ready to move. That's when you step in, not before, not after. I always wait for the market to confirm my judgment. I may be early in my thinking, but I never want to be early with my money. That's how you go broke in a bull market. Now, the fifth and final step, the one that separates professionals from gamblers, is the emotional readiness. You see, no technical rule will save you if your emotions aren't under control. You can have the perfect setup, the ideal confirmation, the strongest trend, and still ruin it by impatience or fear. I've done it myself. After my first big wins, I became overconfident. I thought I could outsmart the market. I stopped waiting for confirmation and started buying because I wanted times to be right. And that's when the market slapped me in the face and took it all back. The perfect entry means nothing if you enter it with the wrong mind. You must be calm, detached, and willing to walk away if the price doesn't act as expected. That's the fifth test I always apply before every buy. If I feel anxious, greedy, or uncertain, I know I'm not ready to act. The best trades I ever made were the ones that felt effortless because everything lined up inside me and in the market. So, let's review. First, the general market trend. Second, the group movement. Third, the individual stock behavior. Fourth, price confirmation. And fifth, emotional readiness. Miss one of these, and you'll find yourself wondering why your perfect setup went wrong. Hit all five, and you'll understand why professionals seem to make it look easy. Now, let's make this practical. Suppose you're watching a stock that's been in a long base. The general market is trending upward, the leading averages are breaking new highs, and the overall tone is optimistic but not euphoric. You notice the sector say, technology is also showing strength. Several leaders in the group are making new highs. Good sign. Then, you look at your stock. It's been quiet, moving sideways, low volume, but on a few down days it doesn't fall much. In fact, it closes strong when others close weak. That's the third sign. Now you wait for the fourth step, price confirmation. One day, the stock surges on double its usual volume and breaks above the range it's been stuck in for months. That's not coincidence, that's accumulation revealing itself. You buy on that breakout, not before, and immediately place a protective stop just below the breakout point. Then, you sit back and do nothing, absolutely nothing, except watch how it behaves. If it continues to act strong, you hold. If it reverses sharply and violates your stop, you're out. No emotion, no debate. And that fifth step, the emotional readiness, comes in right there. When the trade starts working, you'll feel the temptation to grab a quick profit. You'll tell yourself, a profit's a profit. But that's the trap that keeps small traders small. The professionals know the first move is just the beginning. They sit tight. The amateur wants excitement. The professional wants results. The difference between them isn't luck, it's temperament. You want to know how many trades I've made where everything looked perfect and I still lost money? Plenty. The market doesn't owe you success just because you followed the rules. But here's the thing. If you keep following these 5 steps, over time, your losses will be small, your winners will be large, and the law of averages will tilt in your favor. That's what this game is about, stacking probabilities. You won't win every battle, but you'll win the war. Now, let me talk about something few traders ever admit: boredom. The greatest challenge in trading isn't losing money, it's doing nothing while waiting for the right moment. The market spends most of its time moving sideways, confusing everyone. In those periods, amateurs get restless. They chase rumors, they overtrade, they nibble here and there. I used to do that. Every time I thought I was missing something, I'd throw a trade on the tape, and the market would remind me that impatience is expensive. Once I learned to wait for all 5 tests to line up, my trading changed completely. Suddenly, I wasn't anxious. I wasn't trying to predict. I was simply responding to proof. You have to remember, the market doesn't reward the clever, it rewards the disciplined. I've met hundreds of clever men who could analyze 10 ways to Sunday, but they had no control over themselves. One piece of bad news, and they'd dump their stock at the bottom. The next week, they'd buy it back at the top, over and over. The perfect entry point means nothing if you can't hold your position with composure. I always said, it's not the thinking that makes the money, it's the sitting. So, when you think about the perfect entry, don't think of it as catching a moment in time. Think of it as a test of alignment between the market, the stock, and yourself. You are not separate from the market, you are part of it. Your thoughts, your fears, your impulses, they reflect the collective mood of every other trader out there. That's why I always say, trading is 80% psychology and 20% execution. The market will always find a way to expose your weakness until you learn to control it. There's a funny thing that happens when you apply these 5 steps long enough. You start to see patterns, not just on the charts, but in your own behavior. You begin to recognize when you're rushing, when you're hoping, when you're trading out of boredom. That awareness is worth more than any indicator on the screen. Because once you can see your own emotions clearly, the market loses its power to manipulate you. Let me give you an example from my own experience. Back in the early 1920 seconds, there was a stock that had been sleeping for months. The whole market was in a bullish mood, and I was watching this one stock quietly absorb selling. Every dip, it bounced back. Every rally, it inched higher. I could feel something building. But I didn't move. I waited for the confirmation. Then one day, bang, the stock broke out with enormous volume. The tape was alive with activity. That was my signal. I bought heavy. Within weeks, it doubled. People asked me, "How did you know?" I told them, "I didn't know. I waited until it told me." That's the difference between guessing and observing. And here's the irony. Most people will hear these 5 steps and still won't follow them. They'll skip 1 or 2 because they want quick profits. They'll convince themselves they have a feeling. They'll say, "This time is different," but the market never changes. It punishes impatience and rewards discipline. The perfect entry point is not about timing, it's about readiness. It's the moment when preparation meets opportunity and emotion stays silent. So next time you're watching the market and your finger is hovering over the buy button, stop and ask yourself 5 questions. 1. Is the general market trend on my side? 2. Is the group moving in harmony? 3. Is this stock behaving like a leader or a laggard? 4. Has price confirmed the move? And 5. Am I emotionally ready to act without hesitation or regret? If the answer to any of those is no, don't touch it. There will always be another opportunity. The market isn't going anywhere. I used to think trading was about courage, but I've come to learn it's about restraint. Courage makes you enter a position. Restraint makes you wait for the right one. And in this business, restraint pays more dividends than bravery ever will. The perfect entry point isn't about perfection, it's about precision, patience, and perspective. It's about being in sync with the market's rhythm, not trying to impose your own. Remember, the market is never wrong. Your opinion can be wrong, your timing can be wrong, your emotions can betray you, but the market itself is always right. When it tells you something, listen. Don't argue. Don't hope. Listen. It's not speaking in riddles. It's speaking in numbers, in movement, in energy. Learn its language, and you'll never chase another trade again. So the next time you feel the urge to buy because everyone else is buying, stop. Run your 5-step test. Be brutally honest with yourself. If it doesn't pass every test, close your chart and walk away. That's the hardest part of trading the waiting. But if you can master that, you'll find that when the right moment comes, it feels effortless. You won't hesitate. You'll just know. And that, my friend, is what separates the professional operator from the public speculator. In the end, the perfect entry point is not a place, it's a state of mind. It's when your logic, your observation, and your discipline all come into alignment. It's when you're no longer reacting to the market, but acting with it. When you can reach that point, you'll understand what I've spent a lifetime learning. It's not about buying low and selling high, it's about buying right.